Hello, my name's Barney Hawkins. I joined the True Potential Investments team in November last year. As Investments Director, my main task, along with Colin and Chris, is to manage the True Potential portfolios and to keep you informed of key developments in financial markets. The main talking points for investors continue to revolve around Brexit and the Trump administration. As we all know by now, the potential for controversy is extremely high, and for anyone involved in the media, there are rich pickings for sensational headlines. There's little doubt that when uncertainty and sensational headlines collide, they can push investors into taking decisions that should otherwise be thought about in a calm, logical, and factually based manner. Thankfully, our 8 manager partners are all savvy enough not to believe everything they hear or see in the news. In fact, they look to take advantage of opportunities created by overreactions in the markets, because this is what multi-asset funds are designed to do: shift from overvalued to undervalued assets through the cycle. If we turn now to price movements in January, during the month we flagged up the fact that markets in the US and the UK made new highs, and this happened against the backdrop of all the uncertainties that we face right now. The Dow Jones index in the US shot through the 20,000 mark, reaching a high of 20,100 on the 26th of January. 10 days earlier, the FTSE 100 in the UK marched up to 7,343, but has since pulled back, ending the month down very slightly. The broader US market, represented by the Standard & Poor's 500 index, was up 2%, but for UK investors, the strengthening of the pound against the dollar reduced this number to barely positive, as we can see from the chart. The best performing equity markets for sterling investors were Asia Pacific, Japan, and emerging markets. The strong performance from emerging markets is particularly interesting because despite the threat posed by Trump's US administration becoming more protectionist, his pro-growth policies have helped boost commodity prices, which in turn benefit many of the resource-rich countries that have developing economies. Turning now to the bond market, the election of Donald Trump on his pro-growth platform has ignited a serious debate about inflation. By putting America first, some argue that this will push up the cost of goods because there will be fewer imports from low-cost manufacturing centers abroad, and American consumers will have to buy higher-priced goods produced in the US. While this carries the potential to hike inflation, no one knows for certain yet if this will actually happen. Meanwhile, bond investors have taken precautionary steps, adjusted their expectations for future inflation, and have been reducing fixed interest weightings. As a result, some government bond prices have fallen, not just in the US, but also in the UK, with gilts down by 1.9% in January. A shift upwards in inflation expectations represents a headwind for bonds, but this wind blows at different speeds depending on where you're positioned in the market. Higher yielding and shorter duration bonds tend to be shielded more from potential interest rate rises than low yielding, long duration bonds. We can see, for example, that in local terms, global high yield and emerging bonds performed best over the month, although the gains were wiped out by sterling strength. In conclusion, equity markets were quite mixed in January for a sterling investor, with returns from investing overseas reduced by sterling appreciating against the dollar, and UK equities also struggled to make headway. Bonds were also mixed, with global high yield doing well, but UK bonds struggling. Interestingly, an area we tend not to focus on a lot is direct property. This is because we don't own direct property in our funds. In January, returns for commercial property were positive. However, what we noted is that according to the Institutional Property Data Bank, investors gained a lowly 2.6% during all of 2016.